I know most of us most probably like these because we think, oh good, no, I can live off of this because I can get a monthly income. Hey guys, welcome back. My name is Nicole Mjoli for those of you who don't know me, and in today's video we'll be discussing the different types of stocks available on the market so that you can decide which stocks are good for you. If you do find any value from this video, please do like, subscribe, as well as share this video with friends and family. Stay tuned. So you might be asking, how does knowing different types of stocks help you with your investing? It's simple. You get to decide what type of stocks you are interested in, whether it be dividends, whether it be growth, whether it be any type, so that you can diversify your portfolio according to what you like. Okay, first type of stocks that you find are your blue chip stocks. These are stocks of companies that have been around for quite a while. They are high quality and very low risk. They have a very good history, for example, your McDonald's. So why would you like these stocks? As I've mentioned, they do not have a high risk and they have steady growth as well as predictable dividend payments as well as earnings, right? One of the downside of these type of stocks is that they are normally very expensive, but at least now we have brokers that allow us to actually invest using fractional shares, meaning you don't have to spend so much money buying full shares from these companies. You can actually buy a fraction of the shares. The second types of stocks are your income stocks or your dividend stocks. I know most of us most probably like these because we think, oh good, no, I can live off of this because I can get a monthly income from these stocks, or quarterly income or yearly income, right? So these type of stocks have higher than average dividends. They pay out more than other companies. And these stocks are relatively safe, but they do, however, most of the time have low growth. Another thing to remember is that some companies might be doing not too good, so they try to attract investors by having dividends, So some companies do that. It's not all companies that do that, but you do need to be careful of the companies that do that. So then you get your third type of stocks, which are your growth stocks. These are for companies that have higher than average earnings and sales growth. The downside of these companies are that they sometimes don't pay as much in dividends, or they may pay no dividends at all. Examples of these companies are Apple and Google, those type of companies that know that you want a piece of them because they will be growing in the long run. So if you're interested in your capital appreciating, then these companies might be for you. Then we have what we call cyclical stocks. So these are the stocks that are basically linked to the growth of your economy. So when the economy is doing well, these stocks do well. For instance, let's say you have a car company. Obviously, when the economy is doing badly, the company might not do so well. But when your people are getting money, people are buying, then they'll be able to buy cars, houses. So those are your cyclical stocks, right? With your cyclical stocks, you might find that you won't stay with the company for a very long time. You might just stay for the period during which it is doing well. So that's one thing to remember. You always need to check how the markets are performing during that time so that you can get in and get out with some profits. Next, we have what we call your defensive stocks. These are your stocks that are basically recession proof, meaning that when the economy is not doing so well, these companies will be flourishing, So for instance, these will be your public utility companies, your companies that manufacture cheaper products like your cheaper food, your beverages, your medication and things like that. Because obviously when people don't have money, they tend to look at these types of companies to buy from. Then the last type of stock that I have for you guys today is your penny stocks. So these stocks are basically your stocks that are very, very cheap. They are also sometimes very high risk. So your penny stocks are stocks which are generally under 1 rand, 2 rand, around those regions. Believe it or not, Amazon and Apple started out as penny stocks. So the good thing about penny stocks is if they do appreciate in value, you can stand to gain a lot of money. But then the opposite is true as well. If they don't gain a lot of value, because they are fairly new or they are fairly cheap, you might lose quite some money, right? As you can see on my screen, I have attached different types of stocks as well as examples of companies within these stock categories, right? So do check them out and then let me know which ones you think are best. Thank you for watching, guys.